Hello and welcome to Moneylife. This is Sucheta Dalal. This week, let's talk about SME IPOs. I'm sure many of you are investing in them, hoping to find the next multi-bagger. But this is not a good fortune story. This is a warning. In fact, unchecked fraud in initial public offerings, especially of SME enterprises, are already setting off loud alarm bells. And if you're not hearing them, it's time to listen. Especially those of you who think you're going to get rich very quickly because the next multi bagger is there and it's moving on to the big screen and you're going to make endless amounts of money. Now, I know that most of you are new to this market. In fact, 8 out of 10 investors in the retail investors in the market today have come after 2020 or 2021, definitely after COVID. You have no memory of the 90s, right? Where there was a IPO mania, a frenzy. Companies came and picked up money, cheated people, and just vanished into thin air. It led to 7 task forces, 10 years of investigation, nothing happened. And believe me, ask your parents, those who are in their 60s and invested in this market stayed away for 10 whole years, a decade. Primary market was dry. Even after IPOs began to revive, the retail quota used to have no investors. Now there is this big boom in SMEs because all you young people new to the markets have no memories of the past. How big is it? The BSE SME IPO Index has shot up 5,000% since 2021. And earlier, there at least used to be institutional investors who probably asked about the price. This time, it is fueled by SME listings and fully retail because institutional investors do not come into small retail IPOs. It is only young individuals who are driving this boom. This is evident from the big jump in applicant to allotee ratio from 4x in FY 21-22 when this market was new to an astonishing 245x in FY 23-24 according to a consultation paper put out by the Securities and Exchange Board of India. What does this mean? It means no institutional investors. When things go wrong, you alone are left holding the baby. And we've talked in the past about how pump and dump operations have 100% dumping in the market. All the stock is with the retail, and there is no institutional stock at all. There is no promoter holding. They just came in, pumped it up, dumped everything, and a bunch of retail people were left holding the baby, right? Now, unlike the 90s, SEBI has been very alert this time. It has gone after people, it has listened to whistleblowers, it's issued repeated warnings, and it's cracked down on a variety of fraudulent and collusive deals which are put out in detail. People don't read. It doesn't make it to mainstream media because a lot of times that is advertisement driven and nobody wants bad news stories there. But there is a but. In a disclosure based regulatory system, which depends on intermediaries to fulfill their fiduciary duties, it is easy for crooks to be one step ahead of the regulator because the rule is disclose. As long as you've disclosed, you can make an IPO. And if an investor still invests despite saying, I'm a crook, I've committed a crime, I went to jail, something happened, if in spite of that investors invest, it's a free world. So the ruling or guiding principle is caveat emptor or buyer beware. So remember, being in a hurry to make quick money is not an investment strategy. Dreaming big is great, but not an investment strategy. It's a dream. So now there's a pattern of deceit that I told you SEBI has gone after and exposed. So let's look at a few brazen IPOs that have come under SEBI's radar. One, Synaptics Technologies made an issue in July 23. In early May, SEBI barred three of the promoters from the securities market for siphoning off 19 crore of IPO proceeds through fake counterparties and, of course, misclassifying expenses. It also docked the lead manager. That's where the buck always stops. First Overseas Capital failed to ensure proper use of proceeds. SEBI then opened it up to 20 other issues managed by the same lead manager, which is First Overseas Capital. You can read more about it at Moneylife. Here's a link to our website. The second was last week, or rather earlier this week. Varia Creations. Listed in April 2024, SEBI issued an interim order against the company on discovering that 71% of the IPO has been diverted almost on the day of listing directly through the escrow account on the instructions of the lead manager in Venture Merchant Banking Services to companies linked to Inventure. Inventure has been barred from new assignments. But what is more shocking is while this IPO was 20.10 crore through the listing, it had already made an application for a 25 crore rights issue. Obviously, so much money diverted. The suspicion is it was going to be used for a pump or pumping operation. The dumping comes later before the rights issue. To con who? You, retail investor. What was the Bombay Stock Exchange doing? It's supposed to be the gatekeeper as an exchange. Good question. We'll come to it later. Now, the third company, Trafficsol ITS Technologies, it cancelled its IPO after SEBI discovered via a whistleblower complaint that it planned to purchase expensive software from a shell company with no proper antecedents. Clearly a sham deal. It also suppressed an undisclosed short term borrowing to pay finder fees, which it was going to repay through IPO proceeds, which means your money going for finder fees and whatever else. Lead manager Ekadrisht Capital Private Limited, no satisfactory answers. In March 2025, SEBI imposed a penalty of 5 lakhs on SBL Infratech, 10 lakhs on its investment banker Fast Track FinSec Private Limited. Why? For false and misleading disclosures and other violations during the IPO. In 2024, SEBI banned the founders of Veranium Cloud Limited and AdShop E-Retail Limited from the capital market after catching serious manipulation of financial statements, fictitious sales, fraudulent announcements, and related party transactions. These are by no means isolated incidents of misconduct. This is a pattern of systemic abuse of the SME IPO framework. SEBI has flagged 12 investment banks for extracting exorbitant fees. So that is a big red flag. When an investment banker earns 15 to 71% of IPO proceeds as compared to the industry norm of 2 to 3%, you have to know there's something collusive going on. Do you look at it? Most of us don't. Now remember, this time is different because you have been warned repeatedly. And don't say SEBI is not going after every single wrongdoing. It's impossible. The problem is so big. But you have been warned. It is your job to look at it and hear the repeated warnings. These have started from Jan 2024. SEBI's then chairperson, Madhvi Puri Buch, had disclosed investigation into IPO malpractices right away. Inflated subscription numbers, use of mule accounts, which is hired accounts to rig listings, gaming of IPO prices through shady media reports. In fact, gaming of IPO prices, grey market premiums, bribe the media, give them gifts is old hat. Happened in the 90s, 30 years ago. The difference this time is a pump and dump ecosystem which has paid promotions through influencers, YouTubers, WhatsApp groups, whom you seem to believe in implicitly, even more than the media, which is much abused. Listen to what whole time member Ashwini Bhatia has to say in his order against Varaya. He says the task almost feels Sisyphean, but when confronted with facts that strike at the very heart of investor protection and market integrity, SEBI's hands are forced. Inaction is not an option. But remember, inaction is sometimes inadvertent because you just can't go after everyone. His order has once again asked stock exchanges, as the first line regulators, to act in a responsible manner. Are they doing it? Will they do it? We don't know. In fact, it raises a troubling question. Are stock exchanges more focused on their profit and their bottom line rather than their fiduciary responsibility? After all, these are listed companies. They are into the quarter on quarter cycle, have to announce better results. So the minute these shady companies build up a froth through trading, stock exchanges are happy. In fact, this is what we alleged repeatedly between 2018 and 20, when the National Stock Exchange, India's by far the biggest exchange with a near monopoly, had 32 broker defaults, which caused massive losses running into thousands of crores to many retail investors. Those were caught running absolutely illegal portfolio management schemes people didn't even know they were giving money to their brokers. So clearly, there is a suggestion and a worry that for profit exchanges are focused on their bottom line and reluctant to act. This time, it is all to do with the Bombay Stock Exchange mainly, because very few of these are listed in the SME segment of the NSE, but they're there on the NSE as well, and both are equally responsible. In fact, SEBI has been listening to whistleblowers, and there is plenty of evidence where it's gone after based on whistleblower complaints. So Rosemeta Digital Services was planning the biggest SME IPO. SME because regulation is less. It was supposed to happen in November 2024. It just postponed its plans after SEBI began to investigate whistleblower allegations of fraud. Delta Water and Infra Solutions amended its prospectus, disclosed old cases and investigations against one promoter, although these cases had been closed in 2022. SmartWorks co-working space also disclosed action by central investigation agencies against the promoters every time because of whistleblowers. But people are not blowing the whistle every time, so you can't depend on this happening. All this has large consequences. It's not just, it's my money, I lose it. When you look at it in an aggregated manner, the losses from the capital market, which is a high risk investment place, are humongous. Retail investors, remember, have lost heavily in derivatives trading as well. SEBI has done studies repeatedly. Its latest one has revealed that 9 out of 10 investors have incurred losses in the past 3 years, and the aggregate losses in the last 3 years are 1.8 lakh crore. This is the 3 years ending FY 23-24. A senior SEBI regulator says, consider what this would have meant for the economy if this money had gone into consumption instead of mere losses. The same applies to retail IPOs. You lose money which you could have spent, gone on a holiday, because you haven't been careful, it's gone. And we are seeing the impact of this. We run a not for profit organization called Moneylife Foundation. We have seen such a spike in requests, desperate requests asking for help to reschedule loans after people have maxed out their borrowings on personal loans, credit cards, apps. Many of it are to pay losses here or gaming, IPL, what have you. But a big chunk is also in the markets. Now, what's the way forward? You know that SME IPOs have light regulation because SEBI wanted to encourage these companies to get listed. It was a deliberate move to create legitimate businesses. Instead, it's opened the floodgates to fraud. After repeated attempts to get exchanges to be more vigilant, sources tell me that SEBI now is looking at whether it should look at clearing the IPOs itself. It has tightened IPO regulation, it has a cap on offer for sale, but it's not ending. Will SEBI vetting IPOs help? Now, history suggests caution because we know there were rate cards in the 90s. It all led to a bust. The famous MS Shoes case, which, if you're above 60, you would remember, ended the whole IPO mania, and the market was dead for 10 years. Remember that date. At that time, investor associations were powerful, active. They have virtually been killed under successive regulators. So many of us, I was part of some of those associations, we suggested IPO ratings. It would have worked because this first line of looking at facts, which you and I feel lazy to look at, would have been looked at independently by a rating agency and highlighted. Now, nobody wants that. Companies who want to make fraudulent IPOs don't want it. The investment bankers don't want it. Their brokers don't want it. So their noise as stakeholders was far larger than that of investors and investor associations. So they ensured that the idea was killed in two ways. First, we had asked that independent ratings be funded independently by investor protection funds, which are available in thousands of crores by with RBI, with SEBI, with IRDA, with everyone. So use that money, keep the ratings independent so that rating agencies are not beholden to the company making the issue. SEBI deliberately, in its wisdom, decided no, companies will get the ratings themselves. So, surefire way of killing the idea. And then the stakeholders, again, who didn't want it, began to do a drumbeat with help from pliable media to say ratings are useless because they're not going to look at the price. Price is a big issue. As you can see with SMEs, price is not the big issue alone. Disclosures, fraud, hiding information is the bigger issue. Do they even have an office? Do they have a business? Are they buying software from shell companies? Are they diverting to investment bankers? This would have been looked at by the rating agencies as an expert with independent payment, but the rest of the stakeholders said it won't work, and IPO ratings have been killed. So you're left on your own, helpless. SEBI is looking at rating IPOs, nothing is going to change. Profit driven exchanges were made the gatekeepers. There's a built in conflict of interest between investor protection and trading revenues. That is not working either. So, the IPO fraud epidemic actually underscores one reality: SEBI alone cannot protect you. Retail investors must invest time to read, research, and think independently, because your carelessness has meant there are no NGOs who are taking this up to protect you, and there are no shortcuts. So, until oversight improves and systemic incentives change, your best defense is skepticism and self education. This time, you've been warned. You have nobody to blame but yourself. If you agree with what I'm saying, spread the word before more people fall into this trap. Thank you. And do subscribe.